Mate, pretty good. How's your day been?
It's been busy with podcast recordings. Actually, I've had two. Look, I don't want to toot my own horn, but two back to back bangers.
Bangers, you reckon?
Yeah, they
Can you
fast track them.
Can you give me and everyone a sense of who or what you
I can
talked about?
tell you exactly who. First one this morning. I've been teeing this one up for a little while, doing a bit of reading on it. I talked with Mugunthan Siva from India Avenue.
Mm-hmm.
Mugunthan is the co-founder and chief investment officer at India Avenue. So yeah, I had a chat with him this morning. It's just such a really compelling investment story. Just India. We predominantly just spoke about the demographics and infrastructure development and the digital infrastructure as well that's gone on to really lay a solid foundation for growth for India. They've got this thing actually called systematic investment plans, or SIPs locally, and they essentially are, think about it, micro investing for locals. Think of it as like Raise on steroids. And it's not just one provider, all sorts of different fund managers and whatnot over there have them. But just through that program alone, you've got 5 billion US a month going into active fund managers in India.
Wow. Okay.
Yeah, it's pretty impressive. Anyway, so I did that, and then I just had a chat with the CEO of Navigator Global Investments, actually. And Navigator Global Investments takes stakes in alternate asset managers all over the world. So that was really interesting, getting the CEO, Stephen Dark, in, who actually back in the day worked at Macquarie with other Rask favourite Steve Johnson.
Oh, really?
Yeah.
So what do they do?
So Navigator take stakes. So they actually, buy into alternative asset managers around the world. So you think about the Pinnacle, the Pinnacle model.
Yep.
It's similar-ish, except they don't do the back office like admin and distribution. They buy into already established alternate asset managers. And when we talk about alternate asset managers, we're kind of referring to, hedge funds. A lot of the business previously was hedge funds. They are diversifying. These are hedge funds that are doing sophisticated investment strategies, charging anywhere from 1% to 3% per annum, and 20% performance. But you're not investing in those hedge funds, their performance. You're investing in the businesses of those hedge funds themselves.
Great. So just while you're doing that, Mitch, I realized we had a bit of as I say to my son, a bit of a typographical error in that there was a bit of a mix-up with the YouTube links, everyone. So, so if you're joining us now, Graham, Peter, fallen down, we can see you all over in the new YouTube URL. So thank you for joining us.
Was that one of my... I'm guessing it was me. Did I do it?
No, I think it's let's just put it down at head office. No, it seriously was an issue with our technology. So it's all good. We fixed that on the fly. So that's all good. And everyone can access the amazing insights we just dropped. I think the best part of the show was just 4 minutes ago. So it's a shame for anyone that's just joining in now. But no, seriously, mate, welcome to the Rask Invest May portfolio update. If this is your first one, it's great to have you. If you're a repeat offender, we are so happy to have you back with us, and thank you. We are going to go through a lot today.
And if you just joined us, that's an unusual page to be starting on. So
let's start on this. Yeah, start on this one. So we're going to go through a few slides today. We've got a lot of things like investing uncertainty. We're going to talk through each of the portfolio holdings. And then we're going to end with actually slightly more personal finance type stuff and questions at the end. There's been a lot of political news in Australia at the moment, a lot of news around superannuation, around tax structures, taxing Australians and in particular investors more. So we'll talk more about how maybe you can think of different ways to tackle that. But firstly, let's get into the slide that everyone loves, which is our general advice warning. Any of the information that we do mention today on the show is strictly general in nature. We don't know your needs, goals, or objectives. So be sure to speak to a financial planner before you act on the information. Rask Invest, which is the investment platform that Mitchell and I run, has a product disclosure statement, or PDS, and it also has a TMD, which can be found on the Rask website. If you just Google Rask Invest TMD or something like that, I'm sure it will come up too. Obviously, please review those documents before you invest with us. If we do talk about ETFs or super funds or any of those other things as well, they also come with PDS. So check that out. Mitch, maybe I'll throw it to you for a sec. What are we going to be covering today and why is it important?
Well, as Mitchell on the slide there is saying, we'll be covering off the portfolio performances. This is a Rask Invest May portfolio update. We'll be recapping the new portfolio positions. We've got the performance of those recently, and I think almost every single one has had a positive month. And right now, of course, grabbing headlines around the world is, of course, the talk of geopolitical tension. It's in abundance. And so I've done a bit of digging into that this week. And so we'll talk about how markets handle that instability. And then, as you've mentioned, Owen, we'll jump into a bit of Q&A on more the personal finances rather than purely related to Rask Invest, about those superannuation changes that lots of people are chatting to us about.
Yeah, sure. Okay, so let's jump into it. We wanted to illustrate our core strategies to everyone. So when we say core strategies, we've obviously got quite a few, but there are the 5 main ones that you see here on the page in front of you. But we also have our cash bucket, which we call solar. So that's just 100% cash and some enhanced securities in there. So that's for more short-term investing. And if you have like a family trust or an SMSF or something like that, sometimes it can be hard to get interest. So we recognize that you can put money there waiting and ready to deploy it. So most people don't put a lot of money in that for the long term. It's just to earn a good amount of interest while they wait to deploy their capital. And Luna is for kids, which is 100% growth. But Mitch, maybe you can talk people through what some of the things we're going to start highlighting to all Rask community members about the way we invest. And this chart is an example of that.
Yeah, exactly. So I think this was really important to put up here because from day one, we've always spoken about what we consider the best expression. So what we try to invest in is the best expression of each asset class that we're targeting. Now, that doesn't always mean passive. We love passive investing. You've heard us talk about passive investing a lot, but we still also believe that there are other approaches that may suit or complement different asset classes. So when we're looking at large cap equities, absolutely, we all know it's incredibly difficult to beat the passive equivalent. And so we get the lowest cost provider there that gives us the best adequate diversification to that asset class that we're looking for. Hence why, when we've got our Australian exposure, we hold VAS, the Vanguard ASX 300, which gives us breadth across the 300 different companies in Australia. When we're going global, we're looking at IVV, for example. And last time I looked, that had a management expense ratio of 0.04% per annum. Really, really difficult. It has been an incredibly difficult index to beat over, say, the last 20 years or longer. But they're not the only games in town. And so where it suits, we do add active and we do add factor-based ETF options into our investing, and where that suits us is slightly more inefficient asset classes, such as bonds, for example. And so that's why you can see there that we've got in the Terra and Mercury component, we've got a larger portion of active because we're bringing in PIMCO down there in our active bond management. We then do see some high conviction global managers that are able to add value. And so we've been able to bring those into our higher growth, our all growth or growth strategies as well. Factor, we've got that in for emerging markets because we do want a bit of a quality overlay when we're investing there. So, but I really wanted to highlight this particular breakdown just to say to people, you can see the overwhelming majority of the portfolios are invested in passive, low-cost index tracking ETFs, and we add tilts or flourishes of active where we truly believe the manager and the asset class can benefit, can add value and benefit from it.
Yeah, so we've also done this and in a way that keeps costs low. So one of the things that people maybe just need a bit of a quick primer on. So when we say factor, let's understand the difference between factor and passive firstly. So passive just means that you're investing in the broad market, like the ASX 200 or the S&P 500 in the United States or the FTSE in the UK, and it's what we call market cap weighted. So that means that the biggest companies get the biggest share of the ETFs and the index. So that's pretty straightforward. And that's actually one of the reasons why it's so hard to outperform, is because you invest more in the bigger companies. The factor strategy basically just says, what other factors other than size could you use to select and weight companies inside of an ETF? And so EMKT, which is one of the ETFs that we use, uses multiple factors. So it's called a multi-factor fund. But that's an example of how you might not just use the size as the determining factor of what goes in the portfolio and in what proportion. Active is where there's human involvement and where you have a human or a team of humans that have some sort of inference that we think is repeatable and is likely to lead to better performance than either of the other two. So that's an important distinction between them if you're confused.
Owen, I'm curious as to which bucket you put ATEC in here.
For me, ATEC would...
Did you put it in factor? Because I reckon you did, considering how the size of factor in that Saturn slice there. Or did you put it in passive?
I think I put it in passive.
Yeah.
I think from memory. Yeah.
I think I was carving it out, and I was almost going to put it as thematic.
Yeah.
Because it's a sector specific. So ATEC, for those who are unaware, that's the beta shares S&P ASX technology ETF. It is an index tracking ETF. It tracks the S&P ASX technology index. And just updating this on the fly here. That's very.
So if I was going to put that in, that would be something like, I would call it a sector.
Yeah, right.
Rather than thematic, because it would be like a sector strategy, and that's available in Saturn, Jupiter, and Martian off the top of my head.
Yeah. So so that's because it does it is a passive approach. It is tracking an index, but it's a very, very specific index.
Yeah, it is. And happy to answer any questions as well, ladies and gents, on any of the ETFs and strategies we're about to cover. Just quickly, performance. As you know, many of you will know, we launched our newest strategies, being Solar, which was the cash one I mentioned earlier on, Mercury, which is the conservative option, and Saturn, which is the all growth option. That was just over a month ago. And so you can see the short-term performance. We don't have, obviously, longer-term performance because they haven't been around that long. But obviously, we're very pleased with the performance of both strategies, obviously, in the first month. That's not necessarily repeatable, so keep that in mind. But past performance is not indicative of future performance, I should also say on this slide. But broadly, I'm just looking the longer term time horizons in here. Exactly what we wanted them to do, they're now starting to do. And hopefully we're delivering on, the lower risk, good performance over the long term. And I'm excited for what Saturn will become. We've had a lot of people shift into Saturn, approximately more than 20% of people in our community have already shifted into the Saturn, which is interesting.
Well, I think if we had launched with Saturn
Yeah.
at the start, I think you would probably see that as by far and away our largest portfolio held by our investors. And I think it speaks to two things. The demographics that we do have, we're definitely seeing, we've got plenty of SMSFs, family trusts, companies, etc., that invest with us. But I'm certainly seeing a cohort that just keeps repeating in the applications that are coming through, and it is young professionals and young families between the ages of about 35 to 50. They've got they might have two good jobs in the household, they might have kids, they're on top of the mortgage, or even sold an investment property or something like that, and they're looking then for that next investment opportunity literally for the next 20 plus years.
Yeah.
And so hence why Saturn is we're seeing a strong cohort of those come through. And I think if Saturn was available 12 months ago, that cohort would be going into that.
Yeah, I think like if your time horizon is 10 to 15 years, and obviously you've got, you self-assess as a higher risk profile, I think that's pretty obvious that people would use that kind of like VGS, the ETF, or BGBL from BetaShares, like even IVV and VAS. There's a reason that those ETFs are by far and away the biggest, is because they're all growth. So that's what people want over a multi-decade horizon. So the one thing that I would add here is don't be surprised over time with Saturn in particular, this one being here, that we do get more active or more thematic or more factor-based in this. I would not be surprised if that over the next 6 to 12 months becomes more active as a result of what you're paying us to do. So just keep that in the back of your mind.
As well, it's got the ability to really take advantage of new ETFs that come to the market as well over time. There will just become a time where we'll be seeing more and more and more ETFs come to the market. You're actually seeing a lot of ETFs come to the market on the SIBO exchange. And some interesting ETFs coming out there, and I've got a few interviews lined up as well with some of those issuers, and this is kind of what I try and do. People might have noticed that I pop up solo on the podcast with a guest more regularly. I am actually targeting guests who I find genuinely interesting, but also I'm targeting guests who I want to learn a bit about, so we could potentially put some of those learnings into practice here with our portfolios too.
Yeah, it's great. So you can tune in on the Australian Investors Podcast anytime you like. And the good thing about the podcast and all of Rask, of what we do, is you learn a lot as you go through. But we also, with Rask Invest, choose what we consider to be the best of breed of everyone that we come across. So if you're interested in investing, listen to the podcast. If you want to learn more, listen to the podcast. But if you're investing with us, obviously you're letting us determine what we think is the best of breed as they come through. So returns for the month of May. These are 1 month returns. So obviously we are very happy with them as we go through them, but we want longer term 5 to 10 year returns. Obviously we made a strategic decision in the month to allocate heavily to ATech, which is technology focused. So I'm extremely pleased that we took advantage of the opportunity when the market was down and out, obviously.
Do not expect 13% a month.
No.
Past performance, no indicator of future performance. I think we're talking
even the REIT, to be honest, is a new addition.
We will most likely talk a lot about ATech in months to come and years to come, as long as it remains a position in the portfolio, because it will be volatile. It will be having big months. It will be having big drawdowns. It's just for the very nature. It's 40 of the 40 largest ASX technology classified kind of companies, but it's incredibly heavily weighted to the top 8, top 10 companies.
Yeah.
So it will be volatile. It will move around. We've certainly had a good starting point with it. Yeah.
Yeah. So just on that, I mean, I will be one of the first to also, caution everyone that we are long-term focused investors. But I also just want to double click on that. I don't want to pay away too much, Mitch, from the reason that people pay us is to be active when they're too scared to be. And you should expect us that when you're too worried to make an investment, that chances are we're going to invest because we've seen a lot. And all of my best returns as an investor in ETFs has come from the moments of severe uncertainty, not through the times where it seems okay and things are returning 1 or 2% a month. There's a lot of people in this industry who will go out and they'll say, if you just avoided the 10 worst days over the past 200 years, you would have done this much better. The problem is, if you avoid the worst days, you almost certainly avoid the best days, because the best days statistically sit right beside the worst days. And so if you're an investor that wants to be even slightly more active, slightly more attuned to what's happening in the investment world, you need to be prepared to act when there is most uncertainty. And you can even see this right here in the ATEC chart. The drawdowns that we're seeing from time to time nowadays, it seems to me, are getting far more swift and far more severe. So massive drawdown, like a drop, and then a massive recovery. Not always, obviously. Sometimes things stay down for a reason. But that basically means that when the time comes to rebalance your portfolio, to invest more heavily into a particular beaten down sector, that is the absolute time that you need to be thinking, how do I do this? And if you don't have a plan, obviously that's the first step, is just having even a plan that with, a few dot points on it would be a great start. But the point is that if you want to be in that world, you do need to have the courage and your conviction when things are most uncertain. And we're going to talk a little bit more about that in a minute, but I don't want to pay away too much. Obviously 13% a month is not sustainable, but that's why there's 12-month returns, and there ideally would be 5-year returns and all that beside it. But you get my point, is that effectively, we are going to make those types of calls, especially in the Saturn strategy. That is what I would highlight as we go through. In the month of May, for these other allocations in our portfolios, also obviously rebounding, just a lot of luck, as we would suggest, as well as a little bit of timing, but a lot of luck. Cash ETFs, expect them to start producing less of a return, much like your term deposit will start producing less of a return. The reality is that interest rates are coming down, so your term deposits will pay less. That's why we're going to start to see more bond ETFs like PRs start to do positive results, because as interest rates come down, the bonds will start to be better. And same with global bonds. This was a negative month for global bonds here, but it's an important reminder that the belly of interest rates is pointing down. So, Mr. Leftovers, are the returns that are mentioned on the ETF provider's website with dividends fully reinvested or without? That is a good question. And sometimes it does vary, Mr. Leftovers. In terms of the performance, it's obviously net of fees. And sometimes the ETF providers do total returns, and that's what we would encourage. But we've mentioned this a few times. Definitely the two reports that you should learn about the ETP report from the ASX, which comes out every month, usually with a bit of a delay. This is kind of my source of truth. So this has total returns in it. When you go down to the green section, this is total returns in here. SIBO also has the same report. Surprise, surprise. This is the other stock exchange in Australia. But this is the one that you would need to use if you are looking at, say, the PIMCO ETFs or many of the newer ETFs, which are only available on the SIBO exchange. So, for example, here you can see, if I zoom right in,
Oh, this one's got both ASX and SIBO.
Yeah, so they've done one better than the ASX. Obviously, they would do that. So, yeah, and these are all free reports, by the way, Mr. Leftover. So you can just jump in and grab one of these every month if you're interested. Mitch, anything else to add before we move on?
No, May was a fantastic month for investor returns. The last 12 months have been really wonderful, to be fair. And, we will talk about it, the global context of what's going on out there. But if you ever wanted to see the saying, the market climbs a wall of worry, if you've ever wanted to see that in practice, the last 12 months have
Donald Trump, tariffs, like literally everything. Ukraine, Russia, Israel, Gaza, Iran. We'll come back to that in a minute, but yeah.
And then hype cycles of AI, and people worrying if it's going to take jobs, and is it overdone, et cetera, et cetera. There's never ever a moment when there's not uncertainty in the future, and newspapers, they don't get paid to make you a better investor. Surprisingly, most investing websites don't get paid to make you a better investor. They get paid for you to click. So they're going to have extreme headlines, and making you concerned and worried, etc. So, and it might be a good time to already just jump straight into it about investing during times of conflict, because the month of May was one thing, but we're always looking forward as investors and looking, at our portfolios and what's coming down the track. And people do see these headlines, and they do see that Donald Trump is, saying that he's got his finger on the trigger, so to speak, and it's all pretty confronting stuff. But so I went this week. I did go back through and take a look at just some data. Now, there's if you just Google or go on the ChatGPT, whatever. Oh, I wasn't telling you to. But
okay, got it.
I was just saying to people watching or listening, if they did, get onto that, would you, Owen?
Yeah.
If they did Google it, you would find article after article after article from reputable sources like Seeking Alpha or Investopedia. I've got things from JP Morgan here, Invesco, etc. Big institutions, and they all pull out numbers around these studies. And no matter which one you kind of tend to look at, they all tell a very similar story. Short term, yes, we experience volatility, absolutely, but it's longer term. It is just a blip in the road, and it gets the markets do get back to business as usual very, very quickly, much quicker than you think they would. And I looked at an Invesco study where they took the numbers, and now if there's a thing, an incident that you're thinking about, or something you're concerned about, Google that concern and index, and I guarantee you that there is an index created around it. And so I found this week the Geopolitical Risk Index, and that was the Geopolitical Risk Index is done by a couple of fellows from the US, and Invesco was. I read an Invesco article on it this week, and essentially what they've done is, and they've done this around the world now as well, is the modern one goes from 1984 or 1980 to today, and they've gotten 10 major newspapers in the US, and they've just literally tracked the different headlines and the density of headlines around conflict and geopolitical events. And as they increase, of course, that index increases and peaks. So it would be, there it is. He did Google it. And so they've done that, and so now they've actually done that with newspapers all around the world, and so it's really interesting. And then they've actually also done it historically back to 1900. So there's a historical one, of course, that uses fewer newspapers, but you can see then. Oh, here we go. It's up on the screen now, And so what the study that I was looking at looked at was after the peaks in this indices, what was the 12-month stock market, the S&P 500 return after that?
Yeah.
After the peak. And on average, it was 22% per annum, 22% for the following 12 months.
So conflict, then, and this is like,
bang.
yeah, and then obviously past performance, future performance, all that warning. So conflict, bull market, basically.
Conflict, volatility, business as usual. It continues its march from the bottom left-hand corner to the top right-hand corner.
Wow.
So, yeah, I found that really interesting. And, I know there'll be articles written about it, or maybe not this particular type of conflict, but there'll be articles written about any certain worry, be it inflation, interest rates, etc. And certain publications out there will publish them, and it'll be, and I want to do this study. The title will be "How to Play Something."
Yeah.
How to play X. I haven't had the time this week to do it, but I'm going to put together something around that and just look at the companies and the ways to play that they've set it and just see how that's panned out, say, after the 12 to 24 months after that. But I don't want to see investors doing that here. A lot of that's already gets priced into the market as well, and into those particular things. Like, say, if they're seeing the conflict, they might go out and there is defense spending ETFs. They might go out and buy Drone Shield, things like that. These are already incredibly well priced investments. So yeah, that's my little rant.
I like it. I didn't know that thing existed, but I'm so glad that it does, because it highlights the importance of, I guess, just staying invested, and particularly through conflicts. And I've got another way that I was thinking about of showing this, which is this here. So if anyone's watching, you'll be able to see.
I think I've seen that chart before.
Yeah, this is a Vanguard Interactive Volatility chart. So if you look at this here, does anyone want to guess, that's watching, since 1990, August 1990, what the return of US shares and the return of Australian shares have been since 1990? Now, there's a few second delay here, Mitch. So if you're watching on YouTube or Facebook or LinkedIn or wherever you get this update, just pop it in the chat. How much do you think? I don't actually know the answer. I didn't observe the answer this morning when I put it together. But
I don't know either. But it's it reminds me of that fantastic comment on the Rask community. At what point can you please highlight in this chart at what point it would have been a good time to sell out?
Yeah. Probably the best time would have been right here, and then you would have had to wait another 15 years to get invested again.
Yeah, you would have had to wait a little while.
Okay, well, I'll take your guess, Mitch, given that we're live.
Geez, I wasn't even going to. Sorry, I wasn't even thinking.
No. But I'll take your guess of what percentage per annum do you think?
Per annum. Okay. US shares since 1990. It's double digit. 12%.
I don't actually know. I'm going to say something like, yeah, that's a good guess. I'd say 12%. I'll just say 11%, just so I'm close to you, for Australian shares, because this was the last time that we had a recession in Australia as well. I mean, COVID, but there was stimulus checks. So I'm going to say that. Let's find out. So Australian shares 9%, US shares 11%. So that's since August 1990 until today. So even though that was a massive conflict in the Middle East, still performed well. And if we go back further, performed even better. Obviously, one of the things that's always happens is that if you stay in cash, you end up not growing your wealth nearly as fast. In some instances, it's less than half as fast. So the basic gist is that, like, on this chart, it's a really good way to visualize the importance of long-term returns. Mr. Leftovers did say 11%, which is similar to what we said, which is for US. That's actually about right.
To be fair, he's definitely the closest.
Yeah. So if the way I think about this, Mitch, is like, we don't know what's going to happen with all of these news stories. Are people still going to need to be invested? Yes, absolutely. Could the worst happen? Yes. In which case,
I think like a direct
Money's not safe anyway.
one direct commodity, an outcome of for a commodity around this is certainly oil. You have seen the oil price increase quite dramatically recently, but it's a pretty volatile commodity. We don't have a lot of direct, like clean, neat kind of oil companies on the ASX. They're usually oil and gas, so you don't have too many really pure play businesses there that can potentially benefit from that. I mean, Woodside would be our largest. It's the 11th largest company on the ASX, but that's oil and gas.
Yeah. It's globally, obviously, oil would benefit. If you're an ETF investor, I'll give you the long and the short of it. Most oil ETFs are actually just horrible because they're synthetic. So what that means is it's not synthetic oil; it's a synthetic ETF. Meaning that, unlike a gold ETF, where you have the gold physically backed in a vault somewhere, basically what happens is if you invest in a gold ETF, gold is picked up from someone else's pile and put in your pile until you sell, and then it's shifted back and you get your money back. You can't do that with oil because oil comes in barrels, and barrels are very big. And so you end up with no ETF being able to provide you with true exposure to oil itself. You end up with oil futures contracts, which are incredibly expensive, inefficient, and don't always get you the return that you think you're going to get from the oil price itself, because they're actual contracts that have to roll over and trade. So it's basically, if you're using an oil ETF, I would say in almost every sense, it's a mistake. You're better off just finding another way to play it. Maybe buy the futures yourself, rather than, if you're going to go down that path, rather than buying the actual ETF. So there was one final thing which I really wanted to talk about, Mitch, today, and this relates more to the financial planning aspects of what we're seeing across the Rask community recently. I'll zoom in just a minute, but there's a lot of talk in Australia about this added tax on super, which by all accounts will come into effect pretty soon, which is a tax on higher balance super funds. And I don't think really anyone seems to have a massive problem with taxing people with $3 million or more in super. The problem is that the way they're doing it, which is a tax on unrealized gains, meaning that even if you don't sell your investment, you're still going to be taxed on the value increasing of that investment, which is basically, it's just silly. And I think they've made it so stupid that anyone who thinks of having more than $3 million inside their super fund, they just want to say, well, this is such a dumb tax policy that we do not want you in any way to keep any money inside your super fund above the 3 million. So this is the first time, like, I've been suggesting this is going to happen for like 10 years, that for people with large balance super funds, super is not the optimal tax structure for people anymore. Up until 3 million, I didn't know where the line would be drawn, but up until 3 million today, unindexed, if it stays where it is in the next 20 years, it will affect about 10 million people. But obviously they'll eventually index it. But basically what it means is if you've got big assets, if you're investing in long-term growth assets, you don't want to do that inside your super anymore, and you don't want to contribute too much more than you accurately can model. So building wealth outside of super is going to become more and more important. But furthermore, stepping back and just thinking about diversification in general, most people would have also been keeping up with the news over the past month around this big, beautiful bill, this tax and everything bill that's currently before the US Senate and looks likely to pass. This tax bill effectively is going to impact Australian investors by the looks of it. I don't know the exact implications of it right now, but it looks like it's going to impact Australian investors investing in the US, particularly like super funds, pension funds, that sort of stuff, because it's proposing that unless you play ball with the US and their policies, even in your own country, if you invest in the US and benefit from their companies, you're going to be taxed more. Now, we don't know how that's going to shake out over the next 3, 6, 12 months or even a few years. At the moment, there's a tax treaty for most people that use ETFs or use direct shareholdings in the US. There's a tax treaty for you, and that tax treaty basically gives you, if you fill out the W8 Ben form, it gives you a withholding tax reduction. So instead of 30%, you get 15%. It's potential under this new tax bill that will pass in the United States that it could go to 35 or 50%, which is a significant increase. And it will have the impact of reducing your long-term returns as an Australian investor into the United States. Now, we don't know. There's a lot of water to go under the bridge. I don't want to scare people, but I just wanted to highlight it so you're all aware. And the point that I've got here, and they've made 3 points around this, and there's a takeaway, is that the recent government changes to super highlight the key risk of going all in on super. US tax changes, or I should say proposed tax changes, highlight the risk of going all in on the US. The recent bond ETF and small cap fund manager performance, I should say, highlight the key risk of going all in on index funds. Because obviously you don't want to have an index fund for small cap shares because it's not a good outcome.
It's a terrible index.
Yeah. And you don't want to necessarily have all indexed funds for bonds either. They're okay, but they're not as good as many of their active counterparts. So this whole slide here, this little blurb here relates to here. In that by blending different things together and not being so parochial or one-sided or, there's only one good way to invest, you can actually build a portfolio that is more resilient, not just to investing changes and the whims of the market, but also changes in politicians, changes in geopolitics, changes in the relationships between countries. And so I've just given you 2 things that I want you to take away from today, which is 1, consider investing outside of super and embracing other tax structures. And number 2, remember that it is important to diversify across asset classes, which markets, which you also know, like Australia, US, and that sort of stuff. Asset classes being like bonds and shares and cash and property. Styles, which would be like index, active, passives, individual shares, physical gold, maybe if you're a little bit inclined, or property. Tax structures, which would be like things such as, family trust or an investment bond or your partner's name, your name, super fund, that sort of stuff. They're all different tax structures. And strategies, which would be like factor, thematic, not just market cap, for example. Now, I only wanted to put everyone's...
This is a very nice slide, by the way. You've been busy.
Yeah, so this is a little bit of a treat from myself and Emily in our office, designer. So this slide here, for anyone that's interested, and this is not, this is not financial or tax advice in a sense, but I just
need to put that disclaimer back up.
I want to show you basically how we've structured our affairs in Casa del Rask at my house. This is how we operate. So just so you know, and this is like, I think I've mentioned this in various podcasts, but it gives you a sense of how we are structuring our tax affairs. We are very, very complicated, and this is quite complicated, and it's whatever, but you might be able to take something from it. So just starting the center, it's the easiest way to start. Most of our investments in any private companies is held via our family trust here. It has a corporate trustee. This whole structure, just these 2 shaded areas here, it's about $4,000 to set up, and then you've got annual tax compliance as well. They hold shares in our private companies, but they also hold shares in other stuff that I don't need to go into today. How does it work? So if we get dividends, or if this family trust makes an investment, say, for example, in Rask Invest, if the family trust makes an investment in Rask Invest, any dividends and stuff would flow through the trust to our beneficiaries. And this could be, for example, us as individuals, our family, could even be friends. But it can also flow through to our bucket company. Now, inside Rask Invest, I've given an example of what this looks like. Let me just bring up a different screen here, Mitch. One sec.
No worries. As you're doing that, I'm just going to touch on, you're already planning for another child there, Owen, with the little family image.
Well, you know, why not, eh? Ask my wife.
One for mum, one for dad, and one for the country.
Yeah, well, you never know. So I've actually got some skew if charts on here, but you can see up the top here inside Rask Invest that it's been built for virtually every single tax structure, right? So you can have kids accounts, you can have whatever inside Rask Invest. But in particular, this is this fun one that I've named here, but then there's a bucket company. Then you can have another application and have another kids account or something like that. The important thing is that you can have different structures in the one place, which is really important to us. You can make regular contributions. You can now modify your allocations as well. Remember, for everyone that didn't see this update last month, you can now modify your allocations. There are some rules around that, just so you know. But my point is that if we come back to the structure, sorry, Mitch, I'll just bring up the new one. Replace screen. Back here. The obligatory second child. That's correct. Yeah, that's right, Chase. So if we come back here, that bucket company has its own investments. So you can invest from a company structure. You can invest from a trust structure. Not just with us. I'm just saying with anyone in general.
So do you want to bring? I don't think it's up on the screen, is it?
Oh, I did it not. Oh, sorry. Here we go.
There you
go. Sorry. So the bucket company can have its own investments. Individuals can have their own investments. You can have investment bonds, which are a whole other kettle of fish, which we can talk about another time. You can have different super funds, so his and hers, but his and hers can also have multiple super funds. So, for example, you could have an industry super fund, if we rename this as industry fund, that holds insurance or something like that. And then down here, you can have a DIY super fund like a Net Wealth or an SMSF or something like that. So then you can have multiple super funds doing different things and playing a different role in your overall tax structures as well. A lot of our clients also have pension super funds, and then they pay the pension out and then invest from the pension proceeds into another super fund or into their own Rask Invest account or whatever they want to do. So this is obviously when it gets a little bit more complicated, but I just wanted to show everyone that, let me just check this. Literally everything that you see on the page in front of you, every bubble, except the warning about the tax, this is not tax advice, every single thing that you see on this page in front of you can have its own investment account some way. Even companies, like imagine Warren Buffett's Berkshire Hathaway is a company that can invest. Every structure. And they have different tax implications, different legal implications, and different annual costs. But I wanted to highlight that. It's not just about super and an individual holding. You can have multiple. And we indeed, Mitch, we have lots of Rask Invest investors that have multiple different structures.
Yeah, exactly right.
So I wanted to bring that up.
No, that's good. Just saw a question in the side there from Mr. Leftovers regarding diversification across different asset classes. Looking for how can the everyday person on the street get exposure to private equity. It's interesting you say that. 11 a.m. next Friday, I'll be doing a live session with Emma and Miles from GVF. They invest in public and private companies through that listed investment company. So we're going to be talking about private versus public. More companies are staying private for longer. We'll also talk about passive versus active. They're fantastic speakers. If you've not listened to the podcast I did with them, they're an absolute hoot. The only husband and wife investment combination that I know
I don't know any
that work together. They're a really good time and lots of fun, but actually incredibly knowledgeable as well. So we'll be going over that. But Mr. Leftovers, when you do talk about that, you say, what are options aside from the usual KKR, Soul Pats, etc. There are a couple of good other ASX listed companies that probably don't get as much attention as, say, Souls. It's funny when I'm about to say the names because they're massive and they probably do. But Wesfarmers, for example, holds private, is a combination of multiple private companies. Something that's flying under the radar a bit, I believe, has been the success of SG. Or they've changed the name to SGH Limited, which is Seven Group Holdings, under the guidance of Ryan Stokes. He's done a fantastic job of assembling some wonderful businesses. The acquisition of Boral, for example, was turned out to be absolutely brilliant for them. So Seven Group Holdings, for example, if you buying shares in that, what you're actually receiving underlying is ownership of WesTrac, which is the sole distributor of Caterpillar, the earth moving equipment. You've got Coates, as in Coates Hire. You've got Boral, you've got Alight, SGH Energy, Beach Energy, and of course a significant portion of Seven West Media as well in that business. But
is Beach Energy in there?
Yep.
Ah, wow. Okay.
Yeah, so it's a diversified business, very similar-ish to Solpats, but it's concentrated into those handful of companies. But yeah, they've done a Ryan. Look, if you are watching this today, we'd love to have you on the Investors Podcast.
Yeah, reach out.
I'm sure he's not doing anything right now, and he's watching. So
yeah, he would be. Yeah,
he would be long-term fan of the show.
Yeah. So basically, Mr. Leftovers, you still can use public markets to access private markets.
Just have to look a little bit, scratch beneath the surface, and there's a few there. There's a few LICs around as well, but yeah, these are the major ones.
What's that? I'm not suggesting anyone go and do this, but I just wanted to give people a sense of what you can do. What's it called? I don't think it's real. It's not real commercial, is it? It's real property buying. What's it called? The website. So realestate.com.au owns Real Commercial, but there's another one that allows you to go and see all of the businesses for sale in Australia. If anyone knows this off the top of their head, buy businesses, Australia. Seek Business, that's it. So you Seek, that does the jobs, also allow you to buy a job if you want to buy a business in a box. But you can use this website, and this isn't I don't suggest this to anyone, by the way. And if you are going to go down this road, maybe we've got a podcast coming up actually with a friend, which you don't know about yet, Mitch. There's a podcast coming up on the Investors Podcast that's going to be with someone who embarked on this journey a few years ago and went and bought small private businesses and then goes in and cleans them up and then looks to grow them through time. So we'll be
form their own Seven Group Holdings.
The mini Seven Group. There'll be one group, group of one. So you can use this website, and you can actually go through and learn about businesses, little private businesses near you. A lot of the images are generic, by the way, but you can fill in and you can,
another one for people to go and look at is, and I've been meaning to get back to this fella, so it's a good reminder.
I know it is.
Flipper.
Yeah. So this is where you can buy digital businesses online. So you could buy like a fashion business or a what's another example? A YouTube channel.
Buy a travel blog.
Yeah, you could buy literally anything on this website. So
from literally $1,000 to 10 million.
Yep.
More.
Yeah, and it's fascinating. It is fascinating. So
and all over the world too. So Flipper is the largest marketplace for buying and selling digital businesses around the world. So it is really interesting. So you can see here, a YouTube channel for sale, for example. Anyway, we're going down a rabbit hole here, but
it's just to give people an idea of like the other types of things that you can invest in. Obviously, most people watching this invest with Rask Invest, but there are so many different things in this world that you can invest in. And hopefully that's enough to get people's creative juices flowing. And if you're worried about not enough companies becoming public companies, or if you're worried about ETFs creating big systemic issues in the stock market, which a lot of people are, let's be honest. If you're worried about that stuff, then there are so many other things that you can invest in. And you can do that direct stocks, private markets, all different types of things. And I think one big takeaway I wanted for people from today, Mitch, is just to stay diversified, be open-minded. Yes, our short-term performance of the month of May is not necessarily what we expect this month, But hey, it might be still another very good month, and you've got to embrace uncertainty if you want to be a long-term investor. It doesn't matter if you're individual stocks, index funds, active funds, property, shares. It doesn't really matter. You're going to have to deal with uncertainty one way or another. So try to build a framework for yourself if you don't already have one, or just reach out and we'll be able to point you in the right direction.
Awesome, mate.
Cool.
Good timing to wrap this up, I reckon, because I actually have a couple of investor calls coming up. So speaking of that, if you do want to have a chat with me, jump across to the website. You can just use the chat function, or you can. There is a on the Rask Invest pages, there is a form down the bottom where you can actually book a time slot to come and have a conversation with me. I've got Fridays tend to be my busiest days. Everyone seems to have Fridays off. So they have all the time in the world to have a yarn with me. But it's good. I really enjoy it. It's a lot of fun. So please make use of it.
It is great fun. So get in contact with us, ask us any questions, or jump into the community if you need anything. But Mitch, I'm going to go and dive into that geopolitical index thing. That's pretty cool. So, mate, absolute pleasure. Thanks for taking the time.
Yeah, no problems, Owen. It's just in time as well because my troublesome cat has just woken up.
The notorious cat.
Oh, geez, he's a pest during winter.
But it's been a great month. So thank you, mate. And thank you, everyone who even just trusted us the last year, trusted us for the last couple of months. And indeed, all of you that topped up or opened an account in the last 6 weeks. First of all, well done. And second of all, thanks again. Because it's a big step.
Is hard to do. It is hard to do. And what we tend to see, and what I've seen throughout my career, times like this, you get those who are in do top up.
Yeah,
they're bought in. They are topping up. They're going hard during these periods of volatility, which is fantastic to see. But those people who haven't yet, they do go, geez, I don't know. I might just wait and see.
Yep.
And I think we're not market timers or anything like that, but I think making yourself aware of market history.
Yes.
And that's why we go back through and we do these Google searches of, hey, what happens during this? What happens during that? Actually get the facts and go, okay. And that'll help you make those decisions and overcome and not maybe put off these decisions well into the future. So because we know the sooner you start investing, the sooner you start compounding, dollar cost averaging, et cetera, and getting that snowball rolling. Excellent.
Like it, mate.
All right, mate.
Well, thank you for that. And thank you, everyone, for joining us. We'll be around. Peter, it's great to see you. Mr. Leftovers, jump into the Rask community, keep the conversation going, and bye for now.
Cheers.